The Canadian venture capital fund The Group Ventures (TGV) has launched a lawsuit against the Israeli startup GEOX and several of its directors, demanding the cancellation of a $1.5 million investment contract. If this cancellation isn't granted, TGV insists that each of GEOX's directors be held personally responsible for repaying the invested amount. This case is striking because it puts a spotlight on the critical issue of investor trust and transparency in the high-stakes world of startup financing. But here's where it gets controversial. TGV alleges that GEOX didn't just make a single mistake. Instead, they claim the company engaged in a pattern of deliberate deception. According to the lawsuit, during GEOX's Series A funding round in 2024, the startup presented an overly optimistic picture to attract investors. It reportedly inflated its revenue numbers, misrepresented deals with important customers, and projected aggressive growth, culminating in an IPO by 2029. The narrative GEOX painted was that of a winning opportunity, which persuaded both TGV and another major investor, Flashpoint Venture Capital, which had already put $8 million into GEOX under the same assumptions. In December 2024, TGV committed to invest $1.5 million and received about 54,000 shares in exchange. Yet the fund now claims that this rosy picture was false. According to TGV, GEOX was not a thriving business, but rather losing customers rapidly, with cash burn estimated at $500,000 each month, leading to a worsening financial deficit. The lawsuit states that GEOX's annual recurring revenue stats were exaggerated by roughly half, and that the declared deals with key customers were fabricated. When TGV sought proof and documentation to verify the data, GEOX allegedly provided incomplete and insufficient responses. In parallel, despite these troubling claims, GEOX announced in September 2024 that it had successfully closed a $19 million funding round. This round reportedly included contributions from Flashpoint, the RD collaboration SureTech, and individual investors Ariel Maislos and Noam Lanir. Founded in 2018 by CEO Itzik Lavi, CTO Eli Lavi, and Guy Attar, GEOX focuses on developing an innovative platform that evaluates risks to real estate caused by climate-related disasters. Utilizing advanced 3D analysis of aerial photography, the company's technology automates detailed property assessments, estimating potential damages by examining features like roof size, type, condition, and slope. This data is highly valuable for insurance providers covering both commercial and private properties. GEOX's response to the accusation was measured yet firm. We remain confident in the company's progress and performance. We regret the dissatisfaction from one investor. We are currently reviewing the legal documents and will respond appropriately. And this is the part most people miss. While the allegations raise serious questions about transparency and ethics in startup fundraising, they also highlight the intense pressures companies face to present themselves in the best possible light. Where do we draw the line between optimism and misleading investors? What do you think? Should investors hold founders personally liable when accusations like these arise? Or is this simply part of the risks inherent in venture investing?